There's a brand new covered call ETF that was launched 7 months ago that's already sitting on close to 100 million in assets, pays at a distribution rate that annualizes to about 9%, and does something that giants like JEPI and JEPQ simply cannot do. Most people haven't even heard of it yet. So today I'm going to break down SEPI, the Shelton Equity Premium Income ETF, and what makes it different, what concerns me, and whether it belongs next to JEPI or JEPQ in your portfolio. So let's get into it. SEPI launched on September 2025. It's listed on NYSE's ARCA. And by the way, when I say ARCA, this is NYSE's electronic exchange where most ETFs trade. And it's managed by Shelton Capital Management, which is a Denver-based boutique firm that's been around since 1985. The way that SEPI generates income is fundamentally different from how funds like JEPI and JEPQ do it. And that difference matters quite a bit. Here is a quick breakdown on how these three funds generate income. So JEPI uses something called equity-linked notes, or ELNs. It's essentially a synthetic structure where JP Morgan acts as the counterparty. It gets the job done, but you're adding a layer of complexity and counterparty risk. JEPQ sells index options on the NASDAQ 100, simpler, but you're tied to how the index moves as a whole. Now, SEPI writes covered calls directly on individual stocks, and these are positions in the portfolio that have calls written against them right now. Why does that matter? Because when you're writing options on individual stocks, you can target the ones with the highest implied volatility, the ones where the market is pricing the most uncertainty, and extract the richest premiums from those specific positions. Here is an excerpt from an interview done with the portfolio manager of SEPI that further illustrates this point.
So with the underlying equity, we're going to look at the volatility. We're going to look at if it has an X date, if it's has earnings announced.
And volatility is important because when there's more uncertainty, that equals buyers pay more and you collect more in premiums.
In play with the underlying equity, we're going to sell an option off of that. So we're active on the underlying equity. When we're buying equities, we're also active on the options that we sell.
This is actually quite revealing because when he says that they're active on both the equity and option side, if you look, for example, at a competitor like JEPI, they might be active on the equity side, but not usually actively selling options directly the same way that covered call managers do.
So you see a lot of our competitors are basically passive on both, or at least active on the underlying equities, but passive on the options when they're doing index options. We're active management with both of them. So I think that's where we add value.
So what is actually in SEPI? 40 large cap US equity positions. The top 10, which I'm including here, are names you're going to recognize: Caterpillar, Apple, Exxon, Alphabet, Nvidia, Microsoft, Goldman Sachs, J&J, Amazon, and Meta. Now, sector-wise, you've got about 28% in technology, 19% in communications, and 15% in financials. So it's a blended large cap portfolio that skews toward quality and cash flow generating businesses. And the price to earnings sits at 22.9x. The weighted average market cap is 1.1 trillion with a T. And this is not a speculative portfolio. It's actually a blue chip with an options overlay. Now let's talk income because that's why you're here. The quarterly distribution rate is 2.28% over NAV. Annualize that, and you're looking at roughly 9% per year if distributions hold steady. Looking at the monthly distribution history, they've ranged from about 17 to 19 cents a share since inception, and the most recent distribution declared was 19 cents a share. The 30-day SEC yield is 0.54%. Now, before you panic, That number only captures dividend income from stocks, not options premium. And for a covered call ETF, the SEC yield is almost meaningless as a measure of total income. So don't let that number fool you. Okay, I have to address this because if you dig into the Q1 2026 fact sheet, you'll see something that is going to raise your eyebrows. 95.27% of the March distribution was classified as return of capital. And that sounds alarming. And honestly, if you don't know what ROC means in the context of a covered call ETF, it definitely should at least give you a pause. But here's the distinction that matters because there's two types of ROC. One is what I call destructive ROC, where the fund is paying you back your own money because it's not generating enough real income. NAV slowly erodes, and that's bad. Non-destructive ROC is where the fund is generating real economic returns from options premium. But the IRS does not have a clean income category for it, so it gets classified as ROC. NAV stays stable, and that's fine. So for a covered call ETF this young, 7 months old, the tax accounting hasn't fully caught up. Funds like JEPI, JEPQ both distribute significant ROC regularly, and nobody's calling them broken. So a real test is NAV. Is it holding steady? And honestly, we're going to need a few more quarters of data to know for sure. And I'm going to be watching it, and I'll do a follow-up video when the Q2 numbers drop. So is SEPI worth taking a look at for you? Well, here's my opinion, and please note this is not financial advice. It's simply what I believe in my experience. And the structure is definitely differentiated. The management team has real options expertise, and the individual stock options approach gives it an edge in volatile markets, like the one we're in right now. But it's too new to go all in. It does have some very good qualities, and it's a good hidden gem that's not well talked about to uncover, which is why I wanted to mention it in this channel. But it still doesn't have the track record of a fund like JEPI or JEPQ, as an example. But here's what I do plan on doing. I will be doing a full 3-month checkup once Q2 numbers are out. So make sure you're subscribed so that you don't miss on that. Thank you so much for watching. I hope you found some value in this video. I will see you in the next episode, and I hope you have a prosperous rest of your week.